good way to start. So good morning. Thank you, ladies and gentlemen, for coming. My name is Jason Paltritz, Executive Vice President of Corporate Services here at OTC Markets. As you know, we're all here to celebrate the recent closing of the first Reg A Plus crowdfunding deal by Elio Motors that went public on our market, OTCQX, on Friday under the ticker symbol, very fittingly, ELIO. With us today, we have the key people that made it happen. Ron Miller of StartEngine crowdfunding, who will be here to talk about his role. Obviously, Paul Elio, the man behind the video and the car, and the CEO of our company, Cromwell Coulson, who will start the proceedings to talk a little bit about this historic event and the future of capital formation in America. So we're delighted to have you here, and I'll turn it over to Cromwell.
Thank you,
Thanks,
Jason.
Cromwell.
Thank you for that introduction. Today is an exciting day, not just for the people in this room, but for the future of capital raising and finance for small companies. 22 years after the first online broker was started to offer internet trading, and 4 years after President Obama signed the Jobs Act, we're seeing a revolution of raising capital online. Last March, the SEC adopted the final rules under Reg A Plus, under Title IV of the Jobs Act. It allows small companies from the US and Canada to raise up to $50 million from unaccredited investors. Reg A Plus is perfectly designed for a future of finance that is online, data-driven, and social. Raising capital is coming out of the back rooms. The confidential offerings are going away. The internet is going to change everything, I've been told. And it is unbelievable that our securities laws made it illegal to raise capital, to sell new securities across the internet until now. Since the passage of Regulation A+, more than 70 companies have filed with the SEC to raise capital, and at least 22 have been approved by the Commission, including Elio Motors. So on February 16th, Elio closed on nearly 17 million of Regulation A offering from 6,000 investors. You cannot reach 6,000 investors with a confidential offering over the phone. You can't reach your consumer base. You can't reach the people who want to drive in your car or the people who want to drink your coffee. But you can on the internet. And on February 19th, the company's securities began trading on our OTCQX market under the symbol ELIO. So we're thrilled that Elio Motors chose to have their securities traded on our OTCQX best market. Since our company, OTC Markets Group, started with a crazy idea, and it is quite a while ago. It was in 1997 that I purchased an old print publisher that was going bankrupt and said, I want to take trading electronic and make it more transparent. We've understood the struggles that it takes to overcome and make the world a better place. When we first started our path to taking our markets electronic, I called the largest market maker at the time on NASDAQ, and the senior guy there said, why did you buy that company? They're going bankrupt. And I said, I want to take it electronic. He said, traders will never want you to take it electronic. This is just going away. This technology thing, I'm like, no. Securities trading is changing. And if I'd gone to the largest market participants at that time with my ideas, it would have failed. But we blazed forward, and today, we're a market for 10,000 securities with all the leading financial firms, highly regulated, part of the nation's infrastructure. But what we've also done is, because we come from those entrepreneurial roots, we've made our top two markets, OTCQX and OTCQB, to be tailor-made for a new generation of innovative crowdfunding offerings. And it's really three reasons. Firstly, we offer better regulated markets with flexible listing standards to meet the needs of innovative companies and their investors. It's not the old boys club anymore of who you know and have shown that you're a huge success. It's about a world that's online and data-driven, making sure investors have on their screen the information they need to make the right choices around risk. OTCQX, where Elio trades, is our highest market, which is for the most established and investor-focused companies. Companies that trade there must meet high financial standards, be current in their financial reporting, and be sponsored by a professional third-party advisor. Elio is sponsored by W.R. Hambrecht, who has a history of innovation in the technology space, I've been told. I think they're well known in California. But there are currently about 400 companies traded on our OTCQX market, representing a combined 1.5 trillion in market capitalization. These range from the ADRs of large global companies like Adidas, Heineken, and Roche, as well as more than 70 community banks and smaller growing US and international companies. If you look at the community banks, I think this is a really important piece when you think of crowdfunding, because the community banks were community funded. People would come together and say, we need a small bank, we need this management team. And you could do that locally, but now you can do this over the internet, and it's just going to explode things. OTCQX looks a lot like NASDAQ in the 90s with today's technology and transparency. OTCQB is our venture market, which is for developing companies that are committed to providing a transparent and efficient trading market for their investors. This is the market entrepreneurs need today so they can grow for tomorrow. A venture market gives entrepreneurs at the most basic level a shot, a place to start, before they've figured everything out. It's a market that can price risk, and it's going to have a market that has successes. I mean, last year we had 60 graduates from our markets to the exchanges, which made us the global leader in exchange graduates. But it's also going to have companies that fail, and that's really important. Is a venture market needs to be about giving entrepreneurs a shot to succeed. Secondly, and when we think about OTCQB, the market cap's 9.5 million on the median. You know, this compares to OTCQX, where it's a $40 million median market cap. So we're giving the smallest companies a shot with QB. And I think that's really important for the entrepreneurial ecosystem of America. Secondly, our top market, OTCQX, is less than half the cost of NASDAQ's lowest market. And our OTCQB market is less than a quarter of the cost. I mean, this is disruptive pricing for having a well-regulated, transparent public market for companies to trade with. Our markets provide transparent and trusted public trading through online brokers and allow small companies with limited budgets and limited management resources to allocate their time towards growing their companies rather than meeting complex and costly exchange listing requirements designed for the S&P 500. Thirdly, unlike a stock exchange, we operate as a broker-dealer market, an SEC-registered alternative trading system that electronically connects a diverse community of competing broker-dealers providing liquidity and execution services. Just like NASDAQ before it became a stock exchange, our network-based model helps foster liquidity in small company shares by allowing broker-dealers to provide more liquidity than what is displayed. For small companies, liquidity is not a bountiful natural resource. You need broker-dealers every day. Broker-dealers acting as market makers who are creating liquidity, broker-dealers who are acting as agency brokers who are seeking out and finding liquidity. And what you need is competition. You don't need a centralized one-fits-all matching engine where anonymous orders are entered and they're trying to do them faster and faster and faster. What you need is brokers. And those brokers are using technology today, much more technology, but there's still humans pushing it, and pushing the information around. And that side for us is building that network of broker-dealers, using the internet model, which is connecting people electronically, is really transformative and a difference. If you don't have liquidity, centralizing all your orders in one matching engine, you're still not going to have liquidity. And you're not going to have the ability to provide good execution quality through the online brokers. And our transparent and regulated, well-regulated markets can provide the visibility, transparency, and trading liquidity for a wide range of US and global securities, including exciting, innovative crowdfunding companies. But enough about us, because today, I really want to talk about the stars here. And what we've been doing is grinding along, building the plumbing of Wall Street, and I feel we've been spending our whole time waiting for crowdfunding to start. And, markets and exchanges, we don't raise capital. Investment banks do, companies do, crowdfunding portals will. So I'd really like to congratulate Elio Motors on its successful offering and debut on our OTCQX market. It is the innovators like Paul Elio and Ron Miller at StartEngine who are helping pave the future of finance for small companies. We and I owe them a debt of gratitude for taking the risk and making the first step. Listen carefully to what Paul and Ron have to say. These are the innovative entrepreneurs that are the future of finance. So Ron?
Well, thank you. Thanks, Colin. Appreciate that. Well, thank you. It's really an honor and a privilege to be here today, and I think I would be remiss if I didn't initially just first off express some gratitude for a number of people who have all brought this about. And first, of course, is Paul Elio and the Elio Motors team, who really, truly participated in what I call it takes a village to get the results here. And it wasn't just StartEngine, but it was also his internal team that partnered together with us and the crowdfunding agency that helped them put together the video that you just saw, the campaign called CrowdFundX, also based out of Santa Monica, California. They were part of that team that sort of brought us to here. And of course, very, very importantly, to Cromwell and Maggie and Jason and the whole OTC team also, who have been here for much longer than what it might seem. Very early on, Cromwell had said that when Reg A Plus finally produces great companies that are prepared and successfully do their raises, that he would be prepared to support the secondary market for the shares that are sold through Reg A Plus. And so from that standpoint, it's really been a very, very important piece as I go about the process of talking with companies who are raising capital. From the big perspective, I know there's sort of a mixed group here of experience. So Reg A Plus really lets companies raise up to $50 million in their first year, and each year after that. The confusion is that it does in fact allow non-accredited as well as accredited investors to invest in newly formed growth companies. And so that is, I think, a misnomer, because many people think that only on May 16th, when Title III goes live, and Title III is also known as regulation crowdfunding, they think that's when, for the first time, non-accrediteds can invest, when in fact, the reality is since June 19th of last year, which is when Paul launched the campaign on StartEngine, was the very first time that the non-accrediteds could invest. So when I think about the Jobs Act, what it really means is two things. Number one, for the first time since really the Securities Act has been around since 1933, lets companies advertise broadly that they're selling shares of stock in a privately held company. And that, while us who are not steeped in the experience of the capital markets don't even think that's really a big deal. So of course, why wouldn't you be able to do that? It's common sense. Why wouldn't you be able to tell people that they can invest? But the reality is that those who are familiar know that there's extraordinary restrictions, and you could end up with a lot of trouble by broadly advertising. So that was a main change of the Jobs Act. The second part was that it allowed what I call the other 92% of the population to invest. Historically, only 8% are accredited investors, and therefore, unless you were very wealthy and very well connected, both were qualifiers. That was the only way that you got in on great companies, Apple, Tesla, Facebook, and the likes. You only got into those if you actually were well connected and very wealthy. Today, all of that changed. And when I say today, it really is under the regulatory scheme that was initially provided by Regulation A+, which has now been supported by StartEngine as a platform and ultimately the OTC as a market, to allow non-accredited investors to participate in these very early stage companies. So from a big picture perspective, that's what's happened, and that's what's happening today. I think that how that aligns to, I think, the shifts in cultural demographics. I know it's sort of fancy, but at the end of the day, it's about millennials, and millennials believe in transparency and authenticity. And they want to be connected to the companies that they do business with. And as traditional advertising becomes more expensive and less effective, then social media becomes king. And social is driven largely by young people who are well connected socially, who are pushing messages. So as a result of that, today, the Elio Motors company, Paul now has an army of 6,600 approximately brand ambassadors who are truly committed to that brand. And so as he puts that car into production, or he brings out the sport model, or he brings out the custom polka dot paint, whatever he decides to do, all of that messaging can be pushed out through that 6,500 army to the average person now has about 1,000 social media contacts in his phone. So basically he now has a reach of about 6.5 million people that he can use to further grow his business through a embedded army of brand ambassadors who will continue to push the message. It's a huge advantage. The second huge advantage to Regulation 8+ is that it lets the issuer set the terms. This is extraordinary because under most circumstances, whenever you're raising capital of any kind, including even a simple bank loan, usually the person with the money is going to set the terms. Here we have a paradigm shift where now the issuer is going to set the terms of the raise. So that includes the number of shares, the class or type of shares, what rights go with those shares or don't go with those shares, and also classically the absence of the traditional control hooks that you would normally see associated with a finance transaction are prevalent in a Reg A+ raise, assuming that the issuer structures that way, which most of them do. So again, two major changes for raising capital for small businesses. One, it allows the issuer to set the terms, and secondly, you have the army of brand ambassadors. The only real downside is disclosure. Obviously, in participating through Reg A+, it's also known as a mini IPO. You have the disclosure obligations that are required, and as such, that is seen by some entrepreneurs as an impediment. But I simply point to the companies that have been listed on the public markets, small, medium, or large, have been essentially operating with that full disclosure, showing their competitors, customers, and stakeholders what the financials are, what the management discussion analysis shows of what's really happening in these companies, and it has not served as any meaningful impediment to building or growing a great company. So I really believe that this is the future. I think Reg A+ is, I sometimes think about it as the great gift of the Great Recession, in that, right? It's amazing what will come out of a good recession, right? And in this case, when Congress recognized back in the throes of 2010 and 11 that our economy and in particular jobs were struggling, and the way to revive those jobs was through small business, that's what gave rise to the passage of the legislation to begin with. And today I think is the culmination of that. Simply because you have legislation, we've all seen legislation that is essentially hallowed due to the fact that for whatever reason it doesn't work. Industry doesn't lock in and use it in the way that it was intended. And that sometimes can be because of either regulatory or legislative restrictions that just make it impractical. And I think there were many. And I think that, I want to give Paul a lot of credit here. There were a lot of folks who said Reg A+ wasn't going to work. And there were a lot of reasons for that. It was too complex, it was too hard, people don't want to invest. Unaccredited investors or non-accredited investors don't have the sophistication. There's no platforms, there's no secondary market. I mean, the list was long of why it is that probably this wasn't going to work. And it really takes pioneers like Paul, Elio, and a number of others that have seen this opportunity and believe in, I guess, the public markets. And when I say the public markets, what I really mean is this new public market of allowing non-accrediteds to invest in privately held companies that gave it that potential. And so I think that today just simply marks the beginning. I can tell you today, just since June 19th, when we launched the platform, we now have about 41,000 registered users on our platform, all of which have been driven to our site by the media, the press, and the various campaigns that have gone up live on the platform. So we now have 42,000, and we're very, very happy with the growth and the adoption that we're seeing in the market. In addition to that, we have about 270 companies that are in the process of considering a raise. I think there are 3 additional ones that just came on board this week. And what it takes to do that, the reality is sometimes it takes that first guy to jump in the pool. And I think you're looking at the first guy that jumped in the pool over there, figure out how cold that water was. And it turns out it was actually not so cold. It kind of worked out. So we're very, very excited with the momentum, the traction that we're seeing. We're very excited with what it means for Title III. Title III is going to let those companies raise up to $1 million a year. We hope that the costs and expenses will be substantially less because they do not need to get the prior authorization of the SEC before they begin selling the shares. And so we're very, very excited at the prospects for growth there. So with that, I think, let me, without further ado, turn it, I guess, back over to Jason.
Just for a second.
Sure.
First of all, we're all technology people, but I don't think anybody can keep an image up on the screen.
Somebody's banging on the podium.
We haven't cracked that code yet.
All right.
Don't let senior management touch the technology. Whatever you do.
So we are going to get to the star of the show, and as
Yeah.
Cromwell said, we do owe a debt of gratitude to the gentleman who did jump in the pool first.
Yeah.
And we are honored and privileged and excited to have Paul come up here, and we welcome him to our market. Before we do that, the guy who jumps in the pool should get something. And so, we're not the New York Stock Exchange. We don't have bells. We do have this. So Cromwell, you can come up as well.
We should probably go.
Yeah, we should probably come out here.
Front.
So we'd like to present this to Paul and Elio Motors for jumping into the pool and welcoming them as the first Reg A Plus company to be quoted on our OTCQX market. So Paul, congratulations and thanks.
Who closes a Reg A Plus offering is going to say, thank you, Paul, because he was the first.
That's a lot of thank you cards.
Yeah, there's going to be a lot of thank you cards because there's always got to be a first, and you're the first.
Thanks. So with that, Paul will speak, and then we'll open it to the floor for questions. Thank you.
Well, thanks for the nice introduction, and I don't want to turn this into an Academy Award speech. I like to say mom and dad, but this project is about partners. When you look how we've created this vehicle, we have 34 of the best suppliers in the global supply base, and how the vehicle was developed is those suppliers coming together and working on the vehicle for 3 days with Elio Motors, and then parting company and coming back 4 to 6 weeks later. A vehicle's never been designed that way with that kind of supplier participation. And on the funding side, it's all about the partners as well. Figuring out what portal to go through was difficult because we really wanted to launch on June 19th, the first day, which means nobody had a track record. And everybody's PowerPoint looked really nice. And so you had to kind of go with your gut. And fortunately, we picked the right horse. I think StartEngine's the premier portal for Reg A Plus. They have a technology background, they're serial entrepreneurs, and they get it. And they've done a fabulous job at helping us go from testing the waters all the way through closing the deal. And so thanks to Ron and your team for everything you guys have done. And then the next partner is OTC Markets. I think that is the right place for Elio Motors. It's got the right combination of disclosure for the investor and lack of overhead for the company. Right? We got 2 years out of the financials, quarterly reports, but I won't have more people in my compliance department than I do in my engineering department. Right? So it's the right blend for Elio Motors, and we're really grateful to be on OTC Markets. We're first at Reg A Plus, and we kind of have a history of doing things different. Our vehicle seats 2 people front to back and not side by side. That's different. We did that because that's the secret to the mileage. We are going to build the most fuel efficient gas-driven vehicle ever, right? Because we're willing to do it different. We're missing a wheel, but once you're seating front to back and you've already moved that air, by tucking 1 wheel behind that airstream that's already moved versus 2 on the outboard, it's the right way to go, but it's different. We're changing how vehicles are delivered. So we're only building our vehicles two ways, standard and automatic, that's it. They all come with air conditioning, power windows, power door lock, and a stereo. Everybody wants that. And all the upscale content you're used to seeing, you can get on your dealer, right? If you want a power leather seat, Lear's our seating supplier. They make millions of those. We can get you that. If you want blind spot detecting mirrors, Continental's the world's largest electronics supplier. They're our supplier. We can get you that. So you walk into our showroom, say, I want the red automatic with the leather seat and the blind spot detecting mirrors. And that order goes off to one of 7 marshalling centers. We close our stores at 9 p.m. and we build out vehicles to midnight. So we're adding content to these fully manufactured vehicles. So at midnight, all those vehicles go on trucks, and with 7 marshalling centers, we're within 9 hours of all of our stores. So at 10 a.m. the next day, you get the vehicle exactly the way you wanted the day before, no matter what time you walked in the showroom. And why that's powerful, that's a big part of the reason why we can attain this sticker price, right? We're targeting $6,800, is because we're not forcing you to buy a bunch of stuff you don't want, right? I have a grudge against lighted vanity mirrors. Every car comes with 2 of them. They're about 20 bucks each. I don't put on makeup. I don't want one. But I've spent several $100s on them over my lifetime. Look around your car. There's thousands of dollars of stuff that you didn't want that you were forced to buy because of the package system. And so by delivering the vehicle differently, you're going to get more value. You're also going to see technology first. So we were at the Detroit Auto Show for the first time this year, and it went very well. And we went to some of the private booths for the various tier 1s, and they're showing us their upcoming technology, and we'll execute that right away. And if the other guys get enamored with it, in 3 or 4 years, you'll see it on an S-Class or a 7 Series, right? So for the first time ever, the lowest priced vehicle in the market will have the newest technology, because we're adding it afterwards, because of our business model. So I think that's really going to become significant, and we're going to have a lot more releases on that over the coming weeks and months. We built our own engine. That's different. We show in LA, at the LA Auto Show, we unveiled the vehicle with the Elio motor in it. And it's the first time an American startup showed a vehicle with its own engine in it since Nash did it in 1951. So it's been 65 years. That's different. It's a big commitment to developing your own engine. But the only way we're going to hit the mileage target and the price target, or have any hope of being close, is by making that commitment. And again, it comes down to partners. Our development partner on the engine is IAB. They do all the engine development for Mercedes-Benz, BMW, Bentley, Bugatti, and others. And our manufacturing partners come out, they're wholly owned by Fiat Chrysler. And so when you look at our partners and you say you're developing your own engine, it's not nearly as scary as the start of its own engine. We got the right partners, just like we do here. A commitment to North American sourcing. We're targeting 90% North American content because it matters. And there are companies who have agreed to move production from other countries to the U.S. to get our business, just because we asked. And we need to start making things in this country. It is making a difference. And then crowdfunding, the 50,000 reservations. I think that's the real story of Elio Motors. That's the real heroes of Elio Motors is our reservations. So we got interested in crowdfunding, and we talked to the big guys, Kickstarter, Indiegogo. They don't do automotive products. And so we thought, well, this is a sexy enough project, maybe we can do this ourselves. And so we've done our own crowdfunding without a website, the assistance of a crowdfunding website. And now we have the most successful rewards crowdfunding project ever. We have 50,000 reservationists. 85% of them are non-refundable reservations. And raised over $21 million, and that accounts for over $300 million of product reserve before we produce a vehicle. That's spectacular. The big guys have never had that many non-refundable reservations on a vehicle a year before they produced it, right? And that's been the key, because we're different. Nobody would believe that we could sell these in meaningful volumes. I mean, it was a big unknown. Can you sell a front-to-back seated 3-wheel vehicle in meaningful volume? It's tough to get people to believe that. And the reservations had the courage to say, this project matters, this product is cool, and I'm willing to put my dollar bills behind it and take a risk alongside you, Paul. Those are the people that have made Elio Motors successful, those 50,000 folks, and counting. And then Reg A Plus. We're doing that differently in that we were the first one to go all the way through the process, right? We did the Tesla Waters campaign that started on June 19th, the first day. We got qualified by the SEC, we accepted investments, we closed, and now we're listed on the OTCQX. So we've done the whole process soup to nuts. And we did that in a time when nobody else wanted to do an IPO, right? In January, there were no IPOs, I think, for the first time in 5 or 6 years. And that's when we did it. So we have a long history of being different, hopefully not goofy different, but different. And the Reg A Plus looks like an overnight success, but it's really not. It was years of developing a compelling product and communicating a compelling project. Because I think our reservations are involved as much for the project as the product. Of the money that we raised, 58% of our shareholders and 64% of the dollars raised came from folks who have a reservation on a vehicle. So that long history of communication and working and success showed up in the Reg A Plus raise. And I think Reg A Plus is incredibly important. The week before we got our qualification, I had a meeting with the private equity guy, and I'm about halfway through my pitch, and he interrupts me and said, why would I invest in your company before you produce a vehicle? And I had two thoughts that ran through my head. One was, thank God the success of my business no longer is predicated on convincing him, right? And two, we've lost the meaning of the equity markets, right? When people were trading stocks at the corner of Wall and Broad under a tree, the equity markets were about creating capitals for businesses to start or for businesses to grow. It wasn't a place for VCs and PE, private equity firms to cash out their winnings, right? It was to create capital, to create jobs. And somewhere along the line, that's gotten lost. And I think Reg A Plus starts to bring the equity markets back to its roots. That this is about creating capital for companies to start and companies to grow. And I think initially in Reg A Plus, you're going to see a bunch of companies start, and then eventually you're going to see a bunch of companies grow. I meet tier 2 and tier 3 suppliers all the time. They're mom and pops organizations with great profitable businesses. They need $10 or $20 million to buy the next piece of machinery to grow their business and can't find the money. And they're not sexy, so I don't think they could have done this first, because you need a good story and buying another piece of equipment and a great story. But as this takes off, I think those people will access Reg A Plus. I think this is the tip of the iceberg, and it's going to make a fundamental shift in our economy, because capital is the fuel of business, and small business drives our economy from jobs growth and GDP growth, right? And we need to make sure that they have the fuel. And I think Ron and Cromwell touched on it, the democratization of investing. It's no longer the few, it's the many who get to vote with their dollars and take a risk and say, I think this one's going to work. And I think that matters. They have a chance to get on Uber and Facebook and all these things that they were precluded from pre-June 19th. And I think that we're going to create a new class of investor, and people hopefully will get the bug and they'll start saving more, right? Because they're investing. I think there's a big potential here. And because of that, I think that, there's a lot of reasons I think Elio Motors has to succeed. This is a really important project for our country. We can create tens of thousands of jobs over the next year and a half. That matters. We can reduce total U.S. gas consumption by nearly 0.5% after 5 years of sales. That matters. And it doesn't jump out necessarily, but if you're struggling in this country, your biggest issue is mobility, right? There was a study by a Harvard economist that said the number one predictor on whether you get out of poverty or not is mobility. It correlates better than crime rates in your community, test scores in your grade schools, or the number 2 parent households. Mobility is the number one predictor. There's a study out in New Jersey that says something like 60% of their chronically unemployed have turned down jobs because they had no way to get there, right? And at $6,800 and 84 miles per gallon, they can afford to get to the job. And another reason we must succeed now is I think Reg A Plus is really important. And because we're first, people are going to watch us, and we need to bring this all the way home. So I really appreciate the support from our partners, the support from our shareholders, our reservationists, and thank you for the opportunity. That's all I got.
Thank you, Paul. So I think now we'd like to open it up to questions from anybody seated in the audience for any of the panelists.
I have just a couple of quick legal type questions. One is, what were the blue sky issues? And secondly, have there been any issues or problems with depositing the shares?
So, I mean, from a big point of blue sky is, blue sky matters for selling new securities. And Reg A Plus at Tier 2 exempts them. And I think we really have to, as America, we have to get rid of blue sky restrictions for companies that are in compliance with federal securities regulation, because it's a mess. Every securities transaction is an interstate transaction. Everything goes across the borders. It's all electronic. If you do a trade through E-Trade, it touches their servers in Atlanta and then goes to New York and back to California. And this is like, we need to suck it up and get rid, and we should take the levels of blue sky which the states have established and say, okay, let's look at what you've done on your laws, but let's just unify. Number is, so it's on the offering side. The secondary part is there is no blue sky, you have to go state by state, but in reality, investors who are buying Elio, who are buying small companies, they're self-directed. They don't need blue sky. In our markets, NASDAQ small cap market never had blue sky. And it was a great, successful market. I mean, if we can do for small companies of America what NASDAQ small cap was in the 90s, it's a fantastic piece. So that's my part of it is, it's a nice to have on the secondary trading. Reg A Plus got us the need to have on the raising new capital where you need it. Now, on the deposit in certificates, it's like some brokers are taking them. A trade print went up, more brokers will take those securities. This is the first mover. Brokerage firms, they've got lots of risk controls. When they see something they've never seen before, they freeze. But then it all starts moving into the system. And I can tell you, because we had the first Title II Jobs Act offering, the Bitcoin Fund, which was launched by Barry Silbert of Second Markets, and he knows a little bit about market structure. And he did a Title II, which the shares were restricted for a year. And then when they became free trading, he took the Bitcoin Fund to OTCQX. There were some struggles getting it through DTC, getting the pieces there, getting brokers to accept them. But then it smooths out and it all works. And that part of it is, long term, if you're a brokerage firm, crowdfunding is going to have a lot of millennial investors. And if you're a brokerage firm, you want those millennials establishing accounts. So you're going to need to figure out on crowdfunding, and crowdfunding on a Reg A, we have a fully registered SEC offering. So, illegal intent to distribute to avoid registration, that's not there with the Reg A offering. It's been approved by the SEC. Number two, on the back end, we haven't talked about Funds America, but they're also an important part of the process. And they're innovating in the back office part, and they do AML on every account. So again, your AML risk there. Also, AML risk goes down below $10,000. So these small deposits, but this is the first time Wall Street has seen this offering. There's going to be some teething issues. It's going to take a little bit of time. A month from now, we're not going to, it's not going to be a huge pain point. And some brokerage firms may lose some clients. But long term, when brokerage firms are sitting there going, why are we not attracting millennial assets? Well, we don't like crowdfunded securities. That's not long-term employment if you want these accounts in 10 years.
Yes?
Can you tell me all about your manufacturing plans for the car, for your prototype here, and then also you talked about a showroom network, and I'm wondering how you established that, just about some of the infrastructure.
Sure. So one of the gems that we got is we control a 4 million square foot facility in Shreveport, Louisiana. And to put that number in perspective, the Empire State Building is 2.8 million square feet. So it's about 1.5 Empire States. We bought it out of the GM bankruptcy. And GM left all the equipment behind. We estimate the replacement cost of all that equipment at like $860 million. We paid a little less. But we have everything you can possibly imagine to build a vehicle in place and working together. So even if you gave me all that equipment for free, it wouldn't be as valuable as it is together, because a manufacturing plant is a unique organism. It's a one-off, and it takes a long time, a lot of money to get it to work in harmony. To have all those lines and robots and everything already there and working together, it was a huge win for us to get this company started.
And you talked about a showroom network where consumers can come in and order and have it by 10 a.m. the next day.
Yes.
How do you propose doing that?
So we plan to have 120 brick and mortar stores, which is an average of 2 per market in the top 60 markets. And that doesn't mean exactly 2, right? Little Rock, Arkansas has 1 and LA has 4, right? But an average of 2. And doing that, we're within 45 minutes of 85% of the US population. And then they're basically strip mall locations. We don't feel like we need upscale real estate. This is a destination purchase. If you want a $7,000 vehicle, you're driving 45 minutes to us, right? We don't need to be around the corner. And quite honestly, people are okay with doing that because you only buy a vehicle every 5 years. The reason there's so many dealerships in a community is for service, not for sales, right? You want that to be around the corner. So we solved that. We have a partnership with Pep Boys. They've agreed to be our authorized warranty service provider. So we have 800 service locations day one.
Also, I'm sorry, don't mean to dominate.
No,
Tesla has gotten a lot of pushback from auto dealers in various states for some of these products. In those states, I'm wondering, anticipating anything like that?
There'll be some. So fortunately, they've paved the way. I share Tesla on many levels every day. They've done a really good job. One, it makes it believable that you can start a car company in America, right? The last American car company that started that's still existing is Walton P. Chrysler in 1928. So it's been a while before Tesla. So, they've done a great job. They've paved the way in a lot of states. We cooperate with them on that issue. Some states that they have issues, we won't, because we're technically a motorcycle. And those laws are slightly different in some states. But we do have 3 airbags, 2 seat belts. We intend to meet all the 4-wheel standards. So although we are a motorcycle, we're not using that to sidestep it.
Yes, in the back.
The question is cost compared to an on-ramp IPO or a private placement, what are the legal fees and the other costs from start to finish in this phase?
It was way cheaper all the way through the process. We're talking about a few percent versus tens of percents. It's like an order of magnitude cheaper to do it this way than a traditional IPO.
And that's, and I think that's a real part is, as I talked to our team, when Salesforce.com started up, there's a whole bunch of SAP integrators who went out there and told every client, no, you need SAP. Well, it's a bit of a stretch. That's a lot of capital for us or an Oracle Siebel system and there's a lot of fees and costs in the traditional IPO. And on the other side, a lot of inefficiencies. The worst part about doing a private placement is you don't get any publicity. And think about it. You're starting a business and you're raising capital and spending all this money, but you're not getting any of the advertising value. And it's more costly. This part is, we're about employing entrepreneurs and workers and building things, whether it is cars, biotech companies, or banks. Lawyers will do fine. We need to make the process more efficient for companies to be public. And it's very empowering because we've suddenly, we have a mommy state where you've got to do this to protect investors. Why not just put the information on the screen and let the investor make the choice themselves? That's what happened in online dating. Has anyone seen a chart of what happened? It totally changed everything. Online dating is where millennials meet their partners. And it's much more democratic, it's much more diverse, and that's how capital markets should be, both on the primary raising and on the secondary trading. And that's our vision. Our vision is, once you put it online, once you make it data-driven and social, it can be much more efficient. The user can make the choices. They're much smarter about pricing risk than any listing, than any stock exchange governance committee or a regulator in Washington. let the people make the choices, and the price will reflect that.
And I would just add in that I think on the whole, just to put it simply, it's probably 1/5 of the total cost of what it would take to do this as an alternative if you had done a traditional capital raise. Instead, it's about 1/5 to go through Reg A+. And that includes the whole package: legal, accounting, the platform fees, the promotion fees, and not only is it 1/5, but as Cromwell mentioned, you also get the benefit of promoting the brand. Because as companies go out and do the capital raise, they're essentially promoting the brand itself and the product and the company and the team. All of that gets exposed. That's what you're showing to people when you're saying, hey, are you interested in investing in this company? Do you believe? And the answer is, well, that depends. And as Cromwell was pointing out, online you get to see the team, the concept, and the vision. And from that standpoint, of course, prior to the actual investment, you get to see the preliminary offering circular as well. And all of that is the information set that people make. So about 1/5 of the total cost.
And the social part's really important. I mean, you're going to see good press about Elio, you're going to see bad press. You're going to see people screaming, loving Elio, and you're going to see people saying that's the dumbest idea on earth. And but that's great. You know, people in a democracy will make a decision.
The legal expense is under 500,000, right?
Legal, in Paul's case?
I don't know off the top of my head.
I can tell you that there are a number of firms, the number of firms that are out there doing Form 1A filings. Those are the standard filing that you do to support your Reg A+ raise, 50,000 flat fee. And that's on the high end. And now you're starting to move down towards 40,000 as they've gotten more experience. And then there's, the other question that you didn't ask that I'll answer is, so what does it cost me afterwards? If you are afterwards going to just remain as a Reg A+ raise and you're not going onto the public markets, they're quoting flat fees legal, $25,000 a year flat fee. That's a radical difference from an S1 filer, for example.
And that's, and these costs are going to come down. Paul's the first, and it is going to become the same way, remember when Salesforce.com, everyone said, you can never put your information in the cloud. That's a toy. That's not a real CRM system. And now you have a whole community of integrators who have actually a much bigger business because they've got the SME space. They have all these companies and the SME space and the small cap space and all these companies that thought it was too painful to be public. And then they're realizing, wow, it's not that painful. And actually putting my information out there puts a scorecard up there. So it keeps my team pushing forward. Like 60-year-old venture capitalists, they don't want to put their credit card in online. The future is people are about transparent about everything. I mean, whether it's on Garmin for how fast you run and how many miles you're putting up, or on your online dating, this is going to change, and companies' transparency is coming. And anybody who's building a closed private network is, you're not going to have the millennials. You're not going to be part of the future.
There's a question in the back.
Yeah, I have a two-part question. First is, do you have your metrics around the onboarding of the primary market and how the investors were affected when they went to the secondary OTC market? And then the second piece is the graduation from being on OTC. What sort of metrics are going to be put in place so the market can see the transparency of trying to get to the next growth phase as an organization? Because one of the largest issues that everyone talks about is how do you take these crowdfunded securities and actually continue to grow them and make them meaningful to the market?
So, a quick piece is, so last year we had 60 graduates. The IPO market was down 64%. The year before we had 83 graduates. Over the past 5 or 6 years we've had 400 plus graduates. So we create graduates. Now what I think is companies are graduating too early. They're not getting what they want, because the time to graduate to an exchange is when you're going to be in a major index. That's the time to graduate, because that's what exchanges are built for, is companies that are owned by index funds and passive investors. Now, you take a look at our OTCQX. We have something called the OTCQX 50. It's the top performing 50 companies. The average return was 33% last year. It's a mix of industries from biotech to banks to graduates to international companies. How much? 20 billion of volume traded in those names? So if you talk about liquidity, 20 billion of volume, that's a lot of liquidity. I saw a NASDAQ private market announcement, which is their unicorn farm. It has $1.2 billion in total liquidity last year. We do that in 2 days, 2 medium slow days. And that part is, this whole idea is, where do you want to go? You want to stay here as long as possible and focus on building your business and creating runway. We're seeing, community banks. We build a subset on OTCQX for community banks. More community banks are leaving NASDAQ, coming to OTCQX, than going up to NASDAQ, because they want to put their time not into regulatory compliance costs. They want to put their time in their community, providing capital, their focus, their management time. We've become over-regulated and over-costly for small business to be public. In the same way Paul wants to disrupt the cost of a car, I want to disrupt the cost of being public. I want to make it easier because we live in a different world. When I started out, there was no way to get investment information online. The professionals had the terminals. You had to go talk to someone or go to a library, and it was stale. Now, the power that an investor has for information or transactional is what an institutional investor dreamed about 20 years ago, in 1996 when the first online broker, or 95 when the first online broker came in. I mean, that is incredible. And that part of it is, our market is changing. And everything that people say you need to be on a major exchange, they said that to NASDAQ companies in the 90s. And guess what? A lot of great companies went public on NASDAQ in the 90s, and a lot of companies are still there.
So, I'd just like to add that on the graduation piece, I don't think you can tell from here. So the part of this being first is there are no experts, right? There is no roadmap. So we're here. We've been here a few days, right? And it'll be tough to tell. We're starting out with over 6,000 shareholders. I think that's unique. How does that affect liquidity? How does that trade? All those metrics that you're going to think about when you're thinking about graduating. We got to see how this plays out. It's really uncharted territory, and there is no advice. Nobody can say, well, the last 10 companies that did it this way. So I think it's a wait and see, but I'm sure it's not next week.
And I think, just to underscore what Cromwell was saying earlier, there were some real timing challenges that came up in this raise. And I think that really underscores how successful this was. So for example, the campaign actually launched and went live 2 days prior to Thanksgiving. So I don't have, like I told you, a lot of depth of experience in the capital markets, but that is not the best time to be selling shares. Then we roll into December, and also holiday season, not the best time to be selling shares. But don't worry, we had January. We saw a market correction close to 15%. So the market is going down dramatically. Again, not a great time to be selling securities. And against all that headwind, what we saw was a market who had a voracious appetite for these shares and who continued to want to invest despite all of that headwind. And so I think that really is attributable to the success and strength of the company, the campaign, and the process, and importantly, the validation that there are people out there that really do want direct-to-consumer securities.
And that's, it's like the part of capital access is, crowdfunding is going to change everything in our space. I mean, the only thing missing is that fully SEC reporting companies can't do Title III and Title IV, Reg A, and that is something we need to fix. We need to get together and say, hey, why can't a fully SEC reporting companies, which have better disclosure than Title III and Title IV, be able to do Reg A? And why can't we have these companies that have disclosure through their federal regulators that's available today and unleash the crowdfunding community on these companies to let them get a shot at access to capital? Because the part that I look at, and here's a statistic that's really important, on our OTCQB market, of companies that lose compliance from the bid price test, only 10% come back. And that is now, that's a small subset of QB companies, but it is. And those ones, the reason is because they have pipes. They've gone to the private placement market with convertible deals. And the convertible turn into death spirals. And if I tell any entrepreneur, do not do a pipe with a death spiral conversion, with a resettable conversion. Stay away from those people. They will come in and tell you how great they are and how they finance you. They are like vampires. And crowdfunding is going to bring transparency and competition to the low end of the pipe space and then take over above into the higher end deals. And that's what we need to do. We need to have every public company be able to use crowdfunding portals to raise capital from the same investors who are buying their shares in the secondary market. And that part is, we still have Jobs Act 2.0 to do.
I think we have time for one more question, and then we have to wrap.
Just curious, just if you could, historically you raised money and then you did Reg A. Now where do you see yourself going? Because at some point you got to raise more money. Are you looking back to the portal, the platform, the regular public market? How do you see it working, graduating up?
We're having those discussions right now. So we have several facilities at our disposal. One, we have a loan application in with the ATVM for $186 million. Obviously, that solves most of the problem if that gets approved. But I don't want to bet the company on the government making the right decision, right? So we're making plans assuming that doesn't happen. And yeah, it's definitely a secondary offering, right?
Something on a platform again, or?
Well, again, because we're the first ones to do this, I've been meeting this week and we continue to meet with folks to figure out what's the best way to raise that next round. Because obviously we're not done raising money. I think we'll continue to take reservations. That will continue to be a source of funding for us. As we hit milestones and get closer to production, I think that the reservations will ramp up.
Traditional bankers now knocking on your door.
They are, yeah, they're talking to me now.
And there's,
said before.
but Reg A, you can raise $50 million a year. So this is a part and this change
33 left to go.
Yeah, there's 33 left to go this year, and then but in reality is they will raise. I mean, my recommendation is if you're a company that has a burn rate, you want to raise capital before the gas tank gets half empty. You can't drive it like you drive your car down the highway. Of course, you can drive much further with an Elio. And we all know that notice when the light's on and you're going there. Public markets will kill you at that point, and biotech companies learn that. But is Reg A is going to be a process, and you can reconnect. And instead of having to go to someone who says, okay, I need, I'm only buying in the private market, so I can then sell it out into the public market, is your public market investors can get a bargain. And not, they'll be like, oh, a 10% discount, this is good. Instead of someone saying, I need to dilute your equity interest to zero. And that's something that is, nobody talks about it, is how do we, regulators don't like parts of the pipe market, but they've never been able to do it. The way you fix it is with competition and transparency through crowdfunding portals, and you reconnect the investor base, which in small companies, a $50 million NASDAQ company, 92% of their investors are individuals, self-directed investors. You have to get over 500 million market cap to have the slight majority be institutions. We don't like to talk about that in America because it's always like, I need more institutional investors. You need to be good with individuals. And we need to talk about that because it's the greatest thing about America's markets is we have self-directed investors, and they've fired their broker. They go through E-Trade, they go through Schwab. They come in, they make their own choices. They look at Yahoo Finance, they do their own research. They meet managements or they watch videos. And that part of America is huge. We need to harness that and let companies use crowdfunding portals to raise new capital from these investors. And that is the biggest change to our market. And we're going to have companies through crowdfunding portals have access to new capital. And that's completely disruptive.
So with that, thank you. We appreciate your time.